Hey everyone, it's Irk with Get Irked. I'm happy to see you all again. Today we're going to talk about how to pick stocks to invest in for beginners, or how to pick the best of breed stocks. These are stocks that you're going to hold for the long term and you're going to invest in them. One of the things I always like to say is, you know what the difference is between a trader and an investor. An investor is in there for the long term and they're buying the company because they believe in it. A trader's in it for a story. They're in it because they want to be there for the pop, for the short term, for a gain they heard about. And traders usually have weak hands. So this isn't about getting rich quick. It's not about investing in a stock that's going to pop suddenly. This is about investing for the long term. So in this episode, we're going to talk about how you pick your stocks and how you build a diversified portfolio. One of the best ways to limit your downside is with a diversified portfolio using diversification. At its most basic level, a diversified portfolio is one where the stocks in the portfolio aren't from the same sectors. Each one is from its own sector, unrelated to the others. By being diversified, your portfolio is going to see the gains of a specific sector, say technology, while other sectors might not be performing well. On the flip side, if technology starts to sell off because investors roll over into industrials or reopening stocks, you won't see as much downside because you have four other stocks that aren't related to technology, and therefore they won't get hit as hard as the one that is. A diversified portfolio should have at least 5 stocks, with each stock making up an equal 1/5 or 20% of the portfolio. Ideally, you'll pick stocks that are in sectors that aren't related to one another at all. And fortunately, there are 11 different sectors that are recognized by the stock market as the most significant sectors. So we'll go through those so you'll know which sectors are which, and I'll also give you examples of which stocks are best of breed for each of those sectors. Now, you always have to remember, I'm not a professional advisor, and any stocks I mention aren't a recommendation for you to buy them. You are still responsible for your own risk. You need to research every stock you want to buy, and you need to understand the limitations and risks of that stock before you purchase it for your portfolio. So what is best of breed? Well, it may be tempting to pick a stock that has a low share price because then you can buy a bigger quantity of the stock. That's what amateur and new investors do. And it's not the right way to do it. You don't want the cheap stock because it's cheap for a reason. Either the company isn't performing as well, either it's not keeping up with the competitors, it has financial issues, it may go bankrupt. You don't want the cheap stock. What you want is the best of breed, the stock that is the leader in the sector. And those stocks typically, because of bigger market capitalization and because of better profits, better performance, their share price will typically be a lot more expensive. In the long run, buying best of breed will almost always outperform any of the others in the sector because the best of breed will continue to perform as well as it has in the past. That's what's made it best in breed. A good example of best of breed in comparison with one that isn't is if you look at athletic apparel. Nike NKE is the best of breed in the space. They always bring the technology, they always compete, they find new ways to reach their consumers, and they always have excellent earnings internationally. This is a stock that is amazing for long-term performance. The problem is, as I'm making this video, the stock price of Nike is $142 and change per share, and it has a market cap of $223.8 billion. It's a big company, and the shares have the price that reflects the value of the company. If you're looking at getting into athletic apparel space, you might consider Under Armour as a good way to get in. And Under Armour is definitely appealing because its stock price currently is just about $19 a share. So in the investor's mind, you can buy more quantity. But it's not about quantity, it's about quality. You should never look at your portfolio in terms of how many shares do I own. It's how much money do you have in that position. What percentage of your portfolio is making up that position? In fact, in the long term, if you can convert your brain to stop thinking about dollars and instead start thinking about percentages, that will make you a more effective investor as your portfolio gets bigger. If you only think about dollar amounts, once you start graduating to larger and larger portfolios, it may be difficult for you to get your mind wrapped around putting $20,000 into a stock or $200,000 into a stock instead of just putting $200 into a stock. But if you're always thinking in terms of percentages, then it doesn't matter. The numbers are the same and the way you play the game is the same. So now, as I mentioned earlier, there are 11 different sectors that are in the market and considered the official sectors. First sector is financials. These are banks, insurance companies, investment firms, and also the new payment platforms like Square and PayPal. So the best in breed in this space is a little bit varied because most people consider JP Morgan, the investment bank, the best in breed as far as banks go. But if you're looking at fintech or financial technology, you might be more interested in PayPal or Square. Both of them are looked at as leaders in the space, and I would make the argument that neither one is really best in breed over the other. The next sector is utilities. Think electric, natural gas companies, and water companies. American Water Works is a good example of best in breed in the space. The thing about utilities is that you don't see the growth in the stock price as much as you appreciate the dividends that they pay. A dividend is the company sharing its profits with its shareholders, and so you get a certain amount of money based on the number of shares you hold. We'll talk more about dividend stocks in a later video too, but that's the utility sector. The next sector is consumer discretionary. Certain stocks like Nike would fall in this, Under Armour, but also Disney, Netflix might fall in this, even though it falls in tech as well. Apple, even though it falls in tech as well. Tesla, even though it falls in tech as well. You can see that some of these companies have overlap across a couple of different sectors. So as long as you're building your portfolio and picking stocks with, I'm buying this because it's representing this sector, like if you had Apple in your portfolio as a consumer discretionary play, you could actually have a tech play as well, although both of them might sell off in that case, and we'll talk about that a little later. The next sector is consumer staples. These are your food and beverage companies. Think Coca-Cola and Pepsi. Companies like that. I prefer PepsiCo to Coca-Cola because PepsiCo has a really robust snack division, which is doing very well for it in addition to its beverage division, whereas Coca-Cola is exclusively beverages. Energy sector is the one that has your oil and gas companies and your natural gas companies, not the ones that provide to consumers, but the big ones when you're thinking Exxon or Chevron. This space is really shaky because a lot of analysts believe that by 2030 we won't be using fossil fuels anymore. That being said, if you wanted to play in the space, the best of breed is always Chevron. This is a robust company. They're working on renewable energy, and they might have a long-term vision that would mean this company won't go out of business, even though the others might if we all suddenly stop using fossil fuels. Next up is healthcare. This includes hospital systems. This includes healthcare providers themselves, anyone who's making medical equipment, anyone doing research on drugs. It's a big sector. If you were going to buy a healthcare provider, you could buy one like United Healthcare. That one's recognized as best in breed for the healthcare space. However, if you wanted to go into biopharmaceuticals, there are so many companies over there that you might actually consider getting an ETF. Now, I know this video is about individual stock exposure, but let's say you want to have exposure to something like biopharmaceuticals, and you don't want the exposure of the volatility of the space, or you don't want to do the research to figure out which one of these companies would be the one you'd have the most faith in on its own. In that case, you could actually buy the biopharmaceuticals ETF by iShares. It's called IBB, and it encompasses the whole space. So that way, if a stock like Sage Pharmaceuticals fails its third round of testing and drops 60% overnight, you aren't going to be as exposed to it because you own the broad ETF and not the single company. The next space is industrials, and this includes aerospace, defense companies, and the big manufacturers of equipment and things like that. The best in breed in this space used to be Boeing, but Boeing had 2 fatal air crashes and well, nobody's flying right now. Although that's expected to come back and Boeing might be a good long-term play for that. In fact, I hold it in my portfolio and it's been one of my best long-term earners. Caterpillar is recognized as probably the big leader in this space right now, the best in breed, because it also plays on infrastructure bills that might be passed by Congress and the construction that would be involved there. The next sector is one most people are familiar with, and it's technology, and it encompasses everything. You could have electric vehicles, you can have computer peripheral sales, you can have anything tech related that fits in this, which includes the cloud. You've heard probably the FANG stocks, which is Facebook, Amazon, Netflix, and Google, or Alphabet as it's called now. But Apple, Microsoft also fit in this. Tesla fits in this. There's a lot that fits into this sector. So much so, in fact, that you might be able to pick 2 from the sector as long as they were really divergent from each other and still have a diversified portfolio. And I'll have an example portfolio later that kind of delves into this a little bit. Telecom is the next sector. These are your wireless service providers. This also typically includes cable companies, satellite providers, and things like that. Comcast is actually a really good best in breed in this space if you wanted the one that was a cable provider. If you're looking at wireless service providers, Verizon is almost always your safest bet. They're very reliable and they have a really good dividend yield. The next space is materials, and this is basically exactly what you think. It's mining, forestry, anything that goes into making stuff. And the best in breed in this space is Freeport-McMoRan. Freeport-McMoRan does a lot of mining and a lot of refining of a lot of different metals. When you're buying them, it's almost like diversifying across the space itself because they're exposed to so many parts of the sector. Next up is real estate. Residential, commercial, industrial, real estate encompasses everything you can think of that's building related. If you wanted to get into real estate and you wanted to play residential, for example, the best of breed is often considered Toll Brothers or D.R. Horton, the home builders. However, a different way of playing this space is actually through Home Depot or Lowe's. Because they target new homeowners, they're going to see more and more business from this new rise of people buying homes. Right now, with the pandemic, it's hard to say what's going to happen to commercial real estate when we get out of it. Are businesses still going to need as much office space as they did before the pandemic and the work at home movement? It's hard to say. So if I was going to play real estate, I would probably do it from the residential side and not really get into the commercial until we see more of it sweat out. To learn more about a company you're interested in, there's actually a lot of free information out there, and one of my favorite sites is Yahoo Finance, or finance.yahoo.com. There you can type a ticker symbol or the name of a company you're interested in and be able to see an entire profile of what the company does. You can see fundamentals, which include their earnings per share, their market capitalization, how much trading volume they see. You can see details on their financials and their background, and Yahoo Finance even has a really decent basic charting application, so you can see the chart over time and even draw trend lines and things like that. If you find that you're really interested in technical analysis, the use of charting to kind of determine the movement of a stock, there's a service I use called TradingView. They have a really good free platform, and if you pay, you can get access to a lot more features, including alerts and different kinds of indicators that people use when they're trading. Full disclosure, if you use my referral code and you do end up paying for a plan, I'll get a $30 referral fee from TradingView. I stand by them. I've used them for years. They're really easy to use. They're web-based and it's incredibly robust. In fact, back when I started trading, I used to have to pay $130 a month for a service called Q Charts, and now I get that same amount of service with the free version of TradingView. If you pay up, you get even more features, but for most people, you probably wouldn't even need to pay up. I'll go into more detail about technical analysis versus fundamentals in a later episode, but the way I buy stocks is both. There are a lot of people who believe you just look at how well the company is operating, the fundamentals, and then there are others who only look at the price action of the stock, the chartists, the technical analysts. For me, I use both technical analysis and fundamentals when I'm picking a stock. I use the fundamentals to choose whether or not the stock's right, and then I use technical analysis to determine what levels I'm going to buy in stages. And like I said, I'll go over details on that in a later episode. What does a diversified portfolio finally look like? Here's the portfolio example I've built, and I hold all of these stocks in one of my portfolios, full disclosure. And again, these aren't recommendations that you should buy these stocks, but it's an example of what a well-rounded portfolio that's diversified might look like. We've got Apple, Disney, Dow Chemical, Nike, and Square. Apple is your technology play. Disney is your media entertainment play. Dow Chemical is your industrials. Nike is your consumer apparel or consumer discretionary play, and Square is your financial or fintech. You have 5 different stocks from 5 different sectors that aren't going to overlap and aren't going to sell off together. That being said, Square and Apple have a little bit of overlap because they're both considered full technology sector plays as well. And so when companies or investing firms roll out of technology, Square and Apple might trade together, but they typically don't. You can make a portfolio of more than 5 stocks that's diversified. In fact, you can make a portfolio as large as you want, really. Most experts suggest that you stay under 10 for 2 reasons. One, as I mentioned earlier, you need to think about spending 1 hour per week per stock, and 10 hours is a lot. But if you get too big, you start getting to the point where you're just basically creating your own ETF, and might be better served if you just bought an ETF that tracked the entire market or the growth part of the market, as opposed to having 15 or 20 stocks that you follow. That being said, I have a pretty large portfolio in my investments in play on my website, which you can follow along each week, and it significantly outperforms the S&P 500 index. If you want to follow along, it's www.getirked.com. And I mention it so often, I have a feeling you're already aware of that. So there you have it, a diversified portfolio that has 5 stocks that you're tracking. You're individually going to invest in them, and now you're protected against sector-specific risk. During a sell-off of a market, there's no way you can protect against that. But at least now you have as much protection as you can get without having any kind of hedging on your portfolio. In a later video, I'm actually going to discuss how we get started buying and what my technique of buying in stages means and how you can customize it to fit your personal investing style.